What if I told you that most people are investing wrong? They're leaving money on the table, making avoidable mistakes, and missing out on huge opportunities to grow their wealth. It doesn't have to be that way. Well, in this video, I am going to reveal the secrets to unlocking your financial potential through powerful investment strategies like SIP, ETFs, and smart stock market plays. What are the common missing points that all do, but when they try to fix it, but always fail? Let's dive in. Okay, let's talk mutual funds. They've been the go-to for so long, and a lot of people think they're the safest, most reliable option. But honestly, that's just not true anymore. In fact, sticking with mutual funds could actually be holding you back from reaching your full financial potential. But if I tell you that there's a better way, enter ETFs, or exchange-traded funds. These bad boys are like the cooler, more efficient younger sibling of mutual funds. And the best part? They come with lower expense ratios, which means more money stays in your pocket, working for you, and growing your wealth. Think of it like this: every dollar saved on fees is a dollar earned towards your financial freedom. Over the long term, even a small difference in expense ratios can make a huge impact on your overall returns. It's like the magic of compound interest, but for your investment fees. And who doesn't love a little extra magic when it comes to building wealth, right? Switching to ETFs is like giving your investments a turbo boost. You're still getting diversified exposure to the market, but with the added benefits of lower costs and potentially higher returns. It's a win-win situation. Now, I know change can be scary, but trust me, making the switch to ETFs is one of the smartest moves you can make for your financial future. So ditch those outdated mutual funds and embrace the power of ETFs. Your portfolio will thank you for it. Here's a common misconception I hear all the time. I should invest all my money on a single day at the start of the month, right? Wrong. In fact, that approach could be setting you up for disappointment. The stock market is a fickle beast, and trying to time it perfectly is nearly impossible, even for the pros. So what's the solution? Investing on multiple days, my friends. Think of it like this: instead of betting all your money on one spin of the roulette wheel, you're spreading your bets across multiple spins. This strategy, known as dollar cost averaging, is like a secret weapon for investors of all levels. Here's how it works. By investing a fixed amount of money at regular intervals, you're buying more shares when the market is down and fewer shares when the market is up. This averages out your purchase price over time, reducing your risk and potentially boosting your returns. Pretty cool, right? Now, you might be thinking, but doesn't investing on multiple days mean more transaction fees? And to that I say, not necessarily. With the rise of commission-free trading platforms, it's easier and more affordable than ever to invest on multiple days without breaking the bank. So, ditch the all-or-nothing approach and embrace the power of dollar-cost averaging. Your portfolio and your peace of mind will thank you for it. Let's talk about a word that often makes people nervous: margin. Now, I get it. Margin, when used recklessly, can be risky. But here's the thing. Using margin responsibly can actually be a powerful tool to amplify your investment returns. It's all about understanding how to use it strategically and safely. One of the smartest ways to leverage margin is by pledging your ETFs as collateral for a margin loan. Think of it like unlocking the hidden potential of your investments. You're essentially borrowing money against your existing assets to invest even more, potentially amplifying your returns. Now, before you get carried away, it's crucial to remember that margin is a double-edged sword. While it can magnify your gains, it can also magnify your losses. That's why it's essential to have a solid risk management plan in place. Never invest more than you can afford to lose, and always be mindful of your margin loan interest rates. A good rule of thumb is to use margin conservatively, and only for investments that align with your overall investment strategy and risk tolerance. When used wisely, pledging ETFs for margin loans can be a game changer for your portfolio. It's like giving your investments a booster shot, propelling them towards your financial goals faster and more efficiently. Just remember to approach it with caution and a well-defined plan. Let's be real for a second. The idea of getting rich quick is tempting. We see those flashy headlines about overnight millionaires and think, that could be me. But the truth is, sustainable wealth building isn't about chasing risky bets or trying to time the market perfectly. It's about having a defined risk strategy and sticking with it. Now you might be thinking, but Graham, doesn't high risk equal high reward? And to that I say, not necessarily. In fact, taking on excessive risk can actually sabotage your long-term financial goals. Remember, it's not about how much you make, it's about how much you keep. And minimizing your losses is just as important as maximizing your gains. A defined risk strategy is like having a financial roadmap. It helps you identify your risk tolerance, set clear financial goals, and develop a plan to achieve them without taking unnecessary risks. This means diversifying your portfolio, investing in assets that align with your risk appetite, and having a plan for handling market volatility. Remember, slow and steady wins the race. By taking a disciplined and strategic approach to risk, you're setting yourself up for long-term financial success. It's about building wealth steadily and sustainably, not chasing quick wins that could leave you high and dry. Okay, let's address the elephant in the room: trading. The word alone can strike fear or excitement into the hearts of investors. But here's the thing. Trading doesn't have to be scary or complicated. It's not just for Wall Street hotshots or financial gurus. With the right knowledge and strategies, anyone can learn to trade safely and effectively. Now, I'm not saying you need to become a day trader glued to your screen 24/7, but even dabbling in trading can significantly impact your overall returns, especially when you factor in the power of compounding. One of the keys to successful trading is understanding how to use margin safely and strategically. Remember what we talked about earlier? Margin can be a powerful tool when used responsibly. By using margin to amplify your trading profits, you're essentially turbocharging your returns. But remember, with great power comes great responsibility. Always have a solid risk management plan in place. Never trade with money you can't afford to lose, and start small. As you gain experience and confidence, you can gradually increase your trading activity. The key takeaway here is that trading doesn't have to be intimidating. With the right approach and a little bit of education, anyone can learn to trade safely and potentially boost their investment returns. So there you have it, the secrets to unlocking your financial potential through smart investing strategies. Remember, building wealth is a marathon, not a sprint. It's about making informed decisions, staying disciplined, and taking a long-term perspective. Don't forget to like and subscribe for more insightful investment strategies. Together, let's build your path to $1 million. See you in the next video.